One day, I stepped into an office at a company that operates in the trading industry. I saw two traders sitting and talking about candlestick patterns and how to become a profitable trader that makes profits consistently in the market. One of them is a complete beginner, and the other is an experienced and profitable trader. I decided to ask both of them some simple questions I knew they would love to answer. We were on a Tuesday. Markets just opened a day before. So I approached one whose face naturally looked like a beginner trader, and I asked him, "Are you in any trade right now?" He sadly answered, "No, I blew up my small account last night." And I then pursue with my insatiable curiosity by saying, "Can you tell me what happened?" And he started to explain what happened. He said that he entered a trade on Monday morning, and the trade moved against him all the day. And by the time he was going to bed, he thought the trend is probably reversing at certain support level, so he decided to add 2 more positions, hoping he would be in a massive profit the next day, the day I met him. I then approached the second trader and asked him the same question. His answer was completely different. He replied the question by saying, "You know, yesterday was Monday, and as the market just opened, he loves to use the Monday to observe the market moves and analyze his favorite trading assets or pairs before start making trading decisions on Tuesday just to minimize his mistakes after the market opens." Before we dive into what separates a profitable trader from an unprofitable trader, let me please ask you to subscribe to our channel if this is your first time here on the channel, and remember to turn on the notification bell to make sure you don't miss any of our videos again. Let's get started. Now, the story I just shared with you has nothing to do with fiction. After 5 years of trading experience, if you'd ask me what makes the difference between a profitable trader who makes money consistently and a struggling trader who finds it too hard to make money in financial markets, I would simply say discipline. You see, it took me more than 2 years before I hit my profitability in trading. I trade Forex and cryptocurrencies, and I can tell you confidently from my personal experience that to be profitable in trading industry, you need discipline and consistency. Just like the story I just shared with you, the fastest way to lose your hard-earned money in trading is simply by going to the chart to click a buy or a sell without proper analysis. Ken Griffin, the founder and CEO of Citadel Securities, an American market-making firm headquartered in Miami, said, "The market is rarely dead wrong. The history books are littered with people who are smarter than the market." In the history of finance, the failure stories are often people who do not respect the market. To help you understand clearly the difference between an unprofitable trader and a profitable trader, let me navigate you through how each one of these different types of traders think. Let's firstly talk about Alex, a newbie trader who just wake up in the morning, he washed his face, brushed his teeth, he took a hot shower, made his breakfast, and after taking his breakfast, he steps into his trading room. All right, yep, another day, another chance to finally nail this. I know I can do this. All those gurus online making it look so easy. Why not me? I've watched enough YouTube videos, read a few articles. I've got the basics down. Support, resistance. Yeah. Okay, this chart looks promising. See that little bounce off that line? Definitely support. Time to go long. Just a small position. For now. Gotta be careful. Remember last time? Ugh, don't even think about it. That was just bad luck. This time will be different. I feel it. A few minutes pass. The price barely moves. Come on, move. What's taking so long? This is boring. Maybe I should check another pair. FOMO is kicking in. What if I'm missing out on a big move somewhere else? Everyone on that forum was talking about XYZ coin going to the moon. Maybe I should just peek. Alex opens another chart, completely unrelated to his initial trade. Wow, look at that green candle. It's already up 5%. See? This is where the action is. My other trade is just sitting there doing nothing. Ugh, fine. Close the first one. It's barely in profit, but a win is a win, right? Gotta lock in those gains. Can't be greedy. Alex closes the slightly profitable trade and jumps into the rapidly moving XYZ coin. Okay, in. This is it. This is the one that's going to make me some serious money. To the moon. Within minutes, the price starts to pull back. What? No, this can't be happening. It was going up so fast. It's just a temporary dip. Yeah, that's it. Just a little breather before it shoots up again. I'll just add a little more to my position. Average down, that's what they say, right? Smart move. The price continues to fall. No, this is not fair. Why does this always happen to me? The market is rigged, I swear. These whales are just playing with us small guys. I knew I should have stayed in that other trade. It was small profit, but profit nonetheless. Alex stares at the rapidly declining balance. Okay, don't panic. It'll bounce back. It has to. I can't afford another loss like this. Maybe I should just move my stop loss a little lower, just in case. It's probably just some volatility. It'll recover. The price hits the new, wider stop loss. Alex's trade is closed at a significant loss. Are you kidding me? This is unbelievable. I knew I shouldn't have touched that stupid coin. Why am I so bad at this? I follow all the rules. Well, most of them. Sometimes you just gotta go with your gut feeling, right? Maybe I need a better indicator. This moving average isn't cutting it. I saw this guy online using 3 different EMAs and a MACD with customized settings. That looks like the secret sauce. I'll spend the rest of the afternoon tweaking my charts. That's what serious traders do, right? They have all these fancy indicators. Alex starts adding and removing indicators, his screen becoming a chaotic mess of lines. Okay, this looks complicated, but complicated must mean it's good, right? More data, more accuracy. Now let's see. This line crossed that line, and the histogram is turning green. Okay, I see a potential entry here. Despite the recent loss and the lack of a solid strategy, Alex is already looking for another trade. Just a small one this time. Gotta be disciplined. Remember what the gurus say. Small, consistent wins. Yeah, that's me now. Disciplined, patient, waiting for the perfect setup. Even though this setup looks suspiciously like the last one I lost money on. But this time, it's different. I've got more indicators. Alex takes another trade, fueled by hope and a desperate need to recoup his losses. The cycle continues. See? It's going up a little. I told you, I knew it. Maybe I should increase my leverage. Just a little. To make back those losses faster. What's the worst that could happen? The inner monologue continues, a constant stream of impatience, rationalizations, a lack of a defined strategy, and an inability to learn from past mistakes. Alex is trapped in a cycle of hope, impulsive actions, and disappointment, consistently preventing himself from achieving profitability. Now, how consistently profitable traders think. Let's now talk about a wise and experienced Forex trader named Michael. In Michael's house, there is a quiet, well-organized home office. 2 large monitors display clean charts of euro to US dollar and British pound to US dollar, along with a trading journal and risk management spreadsheet. Every day after Michael wakes up in the morning, he reminds himself that profitability in trading isn't about chasing every blip on the screen. It's about understanding the rhythm of the market, aligning yourself with its dominant flows, and protecting your capital fiercely. On his trading plan, he outlines Mondays as market observation day, and he would start making trading decisions on Tuesdays. One Tuesday morning after waking up, Michael switches to his Euro to USD chart, which shows clear annotations for key support and resistance levels, trend lines, and a highlighted area indicating a potential setup formation aligning with his strategy and risk management rules. I've been tracking this consolidation for the past few days on the EUR-USD pair. The descending trend line has held firm, but we're seeing some weakening momentum on the lower time frames. My bias remains bearish, but I need confirmation, he said. He pulls up a smaller time frame chart, looking for specific price action patterns. I don't trade based on gut feeling or hope. Every decision is rooted in a well-defined strategy. For Euro/USD, I'm looking for a break below this minor support level, coupled with increasing volume and bearish momentum on the 15-minute chart. That would confirm the continuation of the larger downtrend. Michael glances at his GBP/USD chart, which is currently showing sideways movement within a range. GBP/USD, on the other hand, is in a period of indecision. It's respecting both the upper and lower boundaries of this range. There's no clear signal here, no high probability setup that aligns with his strategy. He opens his trading journal and types a brief note about GBP/USD. Michael then reminds himself again that discipline is paramount. It's about having the patience to wait for the right opportunities and the strength to ignore the noise in between. Just because the market is open doesn't mean I have to be trading. In fact, some of his most profitable days are the ones where he doesn't place even a single trade. He returns to his Euro to USD chart. The price is nearing the minor support level he identified. Almost there. Let's see how it reacts at this particular level. I need to see conviction in the break, a strong bearish candle closing below support. He checks his risk management spreadsheet, which clearly outlines her position sizing based on her account balance and risk tolerance. Risk management isn't an afterthought. It's the foundation of long-term profitability in trading. Michael knows exactly how much he is willing to risk on each trade. A small percentage of his capital that won't significantly impact him emotionally or financially if the trade goes against him. His position size is calculated precisely to ensure that. On the EUR-USD chart, a strong bearish candle closes below the support level with a noticeable increase in volume. There it is. Confirmation, he whispered to himself. He opens her trading platform, carefully enters her trade parameters, the chosen lot size, stop-loss order placed above a recent swing high, and a take-profit target based on a key support level further down. His entry is precise, based on clear technical triggers. His stop-loss is strategically placed to protect his capital if the setup fails. And his take-profit target is defined by logical price levels, offering a favorable risk-reward ratio. He aims for at least a 1-to-2 or 1-to-3 risk-reward on most of his trades. Michael does not stare intently at the chart after placing the trade. Instead, he turns his attention back to his trading journal, reviewing past trades and analyzing their outcomes. Profitable trading is a continuous learning process, so he meticulously documents every trade, the entry and exit points, the reasons for taking the trade, and the emotional state he was in. This allows him to identify patterns in his winning and losing trades, refine his strategy, and understand his own psychological biases. Hours pass. Michael occasionally glances at his charts, but doesn't interfere with the open euro to USD trade. Later, the price approaches his take-profit target. "Almost there! Patience! Let the market do its work," he said to himself once again. The euro to US dollar trade hits the take-profit target, closing automatically with a significant profit. Profit-taking is just as important as entry in any trade. Michael has predefined levels where he will secure profits. Greed can be a trader's worst enemy. Once his target is reached, he take the profit and move on. There will always be other opportunities. Mark Douglas, the author of one of the famous books about trading psychology, said, "Profitable traders don't try to win every single trade they place. They just has a series of trades in their trading system and an edge. Once the edge is identified, they apply a proper risk management techniques to their positions one after the other. Let's say your edge gives you 60% win rate, and you have a 1-to-2 or 1-to-3 risk-to-reward ratio. That means you won't have to be forcing each position to be a winning trade. Instead of focusing on your individual trades, you'd be focusing on your edge and your system. For instance, if you win 6 out of 10 with 1-to-2 or 1-to-3 risk-to-reward ratio, you'll inevitably be profitable. And that is how successful traders are playing the game. What is your edge? What is your win rate? What is your trading system and plan? These should be your most important questions to ask yourself. Nobody makes money in trading just by finding the best trading strategy or the best indicators. Your edge and your system are what you need to make patterns and indicators work into your favor. Add to that, you would need a trading journal in which you would be journaling all your trades consistently. Michael updates his trading journal with the details of the closed trade, analyzing its execution and outcome. Consistency comes from a disciplined approach, a well-defined strategy, robust risk management, and continuous self-assessment. It's not about getting rich quick, it's about building wealth steadily over time by making informed, calculated decisions and staying patient. Knowing that today might be a good day, but tomorrow is a new day with new opportunities, or the discipline to wait for them. Michael closes his trading platform and stands up, stretching. A sense of calm satisfaction is evident. The market will always be there, and your job is to be prepared, patient, and disciplined enough to capitalize on the high probability setups when they present themselves, and to protect your capital when they don't. That's the mindset of a consistently profitable trader. Now you know the difference between a profitable trader and unprofitable trader, or an experienced trader and beginner trader. In essence, the distinction between a consistently profitable trader and an unprofitable one boils down to a confluence of discipline, strategy, and mindset. A profitable trader operates with a well-defined trading plan, meticulously researched and rigorously tested. They adhere to strict risk management rules, cutting losses swiftly and letting profits run. Their decision-making is driven by objective analysis and logic, not by emotions like fear or greed. They continuously learn and adapt, refining their strategies based on market feedback and maintaining a long-term perspective. Conversely, an unprofitable trader often lacks a clear strategy or deviates from it impulsively. They may take excessive risks, hoping for quick gains, and struggle to cut losses, allowing them to escalate. Emotional trading frequently clouds their judgment. leading to erratic entries and exits. They may also fail to learn from their mistakes, repeating negative patterns and lacking the patience and discipline required for sustained success. Ultimately, while market conditions play a role, the consistent difference lies in the trader's approach and execution. Profitability is a result of skill, discipline, and a well-developed trading psychology, while unprofitability often stems from a lack of these crucial elements. Thank you so much for watching this video. If you find it helpful, please give it a thumbs up and consider subscribing if you would like to watch more videos like this. See you next time. Love you and love trading. Thank you.